Hi, I'm Nathan Parker, a partner in Cadwalader's Fund Finance team in London. Thank you for joining us for another episode of Fund Finance Friday Industry Conversations. Today, I'm pleased to be joined by Adam Larsson, who's Managing Director at EQT and sits on the board of the fund manager with responsibility for fund finance, and also by Tom Smith, who is a partner in the London Finance Group at Debevoise and Plimpton. They're going to be talking to us today about the market-leading ESG-linked subscription line financing that was put in place last year. Perhaps to get us started, Adam, you could set the scene by giving us a general overview of the financing.
Well, we, of course, as you know, Nathan, we've been very busy with fundraising over the past few years. So with that also comes the subscription credit facility. So we have been raising actually not only one, but two credit facilities with an ESG link during last year. So the first one, which was then the first of its kind and size on the global finance market, was linked to our equity fund, and we had an initial size of that of 2.3 billion euros. That will actually increase now to 4 billion euros, and we have an upper limit of around 5 billion on that. And then we have, in addition to that, then a second ESG-linked credit facility for infra business line, where we're in fundraising. We've had an initial close of that credit facility of around 2.5 billion euros. So they are both were closed very short time frame last year. So the KPIs that we have in the facilities are the same, and then we'll continue to develop that as we go. But we're of course very excited to be up and running and to have the first credit facility with an ESG link in there. And just maybe briefly on the mechanics there. So the financing has a pricing mechanism in there that is really designed to incentivize our portfolio companies of improving their ESG performance. So, and then especially when it comes to to gender equality on the board of directors, renewable energy, and then also the sustainable governance. So that's it in a nutshell. And these KPIs that we have set here as well, I think important to note there, this is really part of our EQT's higher level targets when it comes to diversity and climate, as well as the governance model.
Yeah, sure. And I guess, Adam, it might be helpful to hear from you as well a little bit about your motivations for putting it in place. I mean, it was, as you say, a sort of first of its kind, and that would present its own challenges in terms of breaking that ground. So what was the thinking institutionally at EQT about why it was the right time to be doing this?
Yeah, the timing has, I think, has always been right in the sense that we have been working with ESG as part of EQT's strategy for a long time, and we've had a dedicated ESG team for almost a decade now, and since inception, there they have been reporting to our CEO and managing partner, because this has been a very important part of the value creation approach that we have within EQT. So together with that, and if we do look at our vision is to be the most reputable investor and owner, and then sustainability will play a natural part of that, and it's also part of the EQT value. So this was actually really nothing new or sensational to us. I think it's nothing really new to the market either as such. The difficulty has been how to implement it. And this is where we have built on this over many years now. And I think when it comes to if we look at our investments that we make, and we just ask ourselves one simple question, there is, do we want to invest and own a sustainable company or an unsustainable company? So the answer to that question is pretty simple for us at least, and it's simply because it's good business. So that has been sort of the theme and how we have reasoned for many years within EQT. So this is also part of the overall investment screening and the DD process that we have when we look at potential targets. So that also includes a clear plan with actions for the portfolio companies. That's part of the 100-day plan, and we really see the value creation in that by adding the ESG to it. So it's always played a very crucial part for us. It's really ingrained in the business and how we operate. So I think more of the timing was probably right last year, and even more so this year, I think, where I think it's ESG as such as is on everyone's agenda. And I think we were just a little bit ahead of starting last year and implementing this last year, a little bit ahead of the curve there. So but for us, it's just a natural next step in our value creation plan.
Yeah, and was it something you approached the banks about, or was it something, like the idea of building it into the financing? Did the banks bring that to you?
We've had discussion with a few banks, so I think there is also maturity. I think some larger banks, international banks, have been discussing this before. I've had discussions with them, and we had seen how to implement that in our credit facilities. And now, I wasn't sure before if all the lenders would be comfortable with this. We need to have a very clear governance around it and very clear KPIs. So for us, we've been ready for a long time, and a few of the banks have. But to us, it's also, we have a quite wide range of banks, a group of banks that we work with. We raised quite a number of credit facilities over the past years. So the relationship with the banks is very important as well. But I think last year was the right timing, where you feel that everyone is moving in the right direction based on the discussions we have with all the lenders. So therefore, I think there was no, everyone was excited when we brought it up and said that we really want to implement this. So I think then, especially when we had the second facility last year, I was approached by most of the banks then who were also part of the first facility, that they would want to take a leading role in this due to the ESG components.
And one of the sorry, I was going to say, one of the interesting things, Nathan, about the relationship with the bank through this process was that clearly 2 or 3 of the banks had a focus on ESG and had been talking to EQT about an ESG facility, but EQT's facilities are very large, so they require more than 2 or 3 banks, and so there's a question there as to whether the other banks will be able to develop their thinking along the same lines, and actually they all did relatively comfortably. I think it's because of the size of EQT's facilities, it's really driven the thinking of ESG amongst other banks in the market, because they've all had to think about it for the purpose of that facility.
Yeah. And what did you think when Adam came and told you he wanted to do the sort of first multi-billion-pound ESG linked facility in Europe?
I first off thought, I hope he's giving me some criteria before we have to draft for it.
Fair enough. Well, maybe talking about criteria, and obviously you probably can't talk specifically about what's in your document, but Tom, maybe you could give us a sense of how the ESG element played into the document. So where did you see yourself visiting clauses and needing to address points? I imagine you have reporting requirements, that sort of thing. It might be helpful for people to hear how that played out.
Yeah, I mean, it played out alongside negotiation of the capital call facility generally. But when EQT came and said they were raising their capital call facility for Fund 9, and they wanted to put ESG mechanics in, they'd already been talking to a couple of the lenders about how they would work and about the KPIs. So the negotiation of those KPIs ran alongside the negotiation of the facility. And the starting point is you take the normal capital call facility form, and you make some very simple changes to the margin, with some very complicated underlying KPIs to go alongside those simple changes. So all the capital call facility says is it starts at EQT's normal market terms, and then the margin can adjust depending on performance of portfolio companies against those KPIs. And I think for any sponsor doing this, the first port of call is to think about what KPIs they might want. It's important that they work for the fund in question. There's a variety of strategies of fund in the market, and what may work for a real estate fund may be different from a private equity fund. And from EQT's perspective, looking at their flagship PE Fund 9 and looking at their infra fund, they've focused on three things. And I think it was important actually to make sure that the KPIs aren't unruly. You pick 2 or 3 things so that it's easy to run the tests going forwards. And they picked one of each, one of E, one of S, and one of G. And for G, the focus point was, does each portfolio company have an ESG person on each board? Has the portfolio company run a sustainability materiality analysis? And does each portfolio company have look forward targets over the medium term? And then for S, as Adam mentioned earlier, the focus is on gender diversity on the boards of portfolio companies. And for E, the focus is on sourcing of renewable energy. And so the way the capital call facility works is you take the margin and you make an adjustment, testing that adjustment 3 monthly by way of reporting against those tests on a 3 monthly basis from the portfolio companies to the fund. The fund brings together that information and provides a summary of the information, like a compliance certificate, to the bank. The bank to the agent. The agent considers it and verifies the information from a factual perspective, and then adjusts the margin straight after that. So ultimately, it's a relatively simple mechanism. You're looking at the margin, adjusting it for the purpose of the KPI, testing the KPIs, and reporting up to the agent with that information to test against the KPIs, underpinned by some complex KPIs themselves.
Yeah. And Adam, if I can ask you this, if it's not too sensitive, did you allow for a margin that moved upwards from the base case as well as downwards for good performance?
Yeah, we did, and I think that was one of the most important parts of this as well. Of course, this is a natural part of our strategy, and Tom went clearly into the details there as well. But I think we need to make sure that we put pressure on ourselves as well, and of course on our portfolio companies in delivering on this. If we don't, then there should be an adjustment on the interest. And if we're successful, the same, then we should get the benefit of that as well. So that's how the relationship, we want the relationship between us and the banks as well. And I think that's really important for us to make sure that this is how we commit to making sure to follow these KPIs. They are not something that we only have on paper. We really want to make sure that this gets ingrained in the way that we operate. So I think that was crucial to have that as part of it, and I think also if you go into previously you asked about the reporting of this as well, and Tom mentioned a little bit how we measure it, how often we report on it. I think this is something that we will use to our advantage. This is very key data points, and we start with the basics. So we have one with E, one with S, and one with G. This is really the core and the basics. This is the foundation which we intend to build on. So when it comes to the reporting, the more data we gather, the better analysis we can do, and when we look at the potential of the value creation in our portfolio company. So we don't look at the reporting as something that we now have to do. It's more that I would say finally we have more of data points that we can keep on adding to, and I think this is really what's going to take ESG to the next level. We need to be able to measure and quantify the results by using this in any part of the business. So that's purely a positive from our perspective.
Yeah. And I mean, Tom, you're obviously a very well-known sponsor counsel, and there's a lot of GPs out there at the moment thinking about their financings. And I think one of the questions we certainly hear asked of us is, what is the best way to arrive at the KPIs? Is there any sort of observations you might have there, just of a generic type for funds generally, as they're thinking about how to set these?
I think the starting point is for a sponsor to think about how it thinks about ESG generally. You're right, sponsors may come to you and say, should we see what the banks think, or should we propose something ourselves? I think it works much better if it's proposed by the sponsor. Each sponsor will have a different focus point from an ESG perspective. For example, if the sponsor invests in real estate, there's likely to be some very nuanced real estate metrics that they care about from an ESG perspective. Whereas if they invest in private equity, something along the lines of what EQT did is more likely to be a focus point. So, and they will have talked to their investors about ESG in the context of raising their funds, and so will have likely developed ESG focuses. So I think that is the starting point. What do you as a sponsor care about from an ESG perspective? What do you think you could change or would want to change in your portfolio companies, and make a proposal to the lenders? And because it's an evolving market, lenders seem quite willing to consider different ESG focused KPIs, as long as they're relatively robust and it's clear that this isn't just a mechanism to get a margin reduction, and that the sponsor's looking to improve the ESG specifics of its underlying portfolio companies, then the lender should be amenable to that.
Yeah. And maybe, I guess, what might also be helpful in that vein of people who are looking at it for the first time is to get a sense from you both about how you found the process of actually implementing it. Tom, you sort of mentioned that it was just negotiated alongside the other capital call terms, but they're obviously much more familiar terms to the bankers and to EQT and to you. Did you look at that? Was there a increase in timetable as a result of needing to bring in this new element to the financing, or was it actually relatively smooth?
I think it's fair to say EQT had clearly considered from an early stage how to manage the process so that it worked in accordance with the timetable. The ESG thinking had happened in advance of the capital call facility starting. From a general sponsor perspective, it's important to think about it early, otherwise it could extend the timetable, because the metrics are complex and they may take some time to get the lender's head around and to document.
Yeah, and I guess it's really a term sheet discussion like that. You need to be talking about it then, and you need to be getting a clear picture of what it's going to look like at that stage.
Yeah, no, and I think that how we operate, of course, we have worked with, myself and Tom have worked with for many years on this as well. So I think that the process as such, we have a robust process there. And I think for ESG, the key thing was to, anything that is new, that is materially different from what we've done in the past, that needs to be discussed and reviewed with the banks before we get to the term sheet phase. So we did that. We have a very close and good relationship with all the banks that we work with. So we had that discussion way ahead of when we actually needed to have signed the facility agreement. So that was actually part of the term sheet, but had been done, prepared and discussed well in advance before that. And I think that's also, just going back to one, the point that we discussed before as well. I think what's important here is that if it's a sponsor or whoever is part of this, it really needs to be ingrained in the strategy that you have as a whole, as a firm. Then I think it's quite easy to find the KPIs that build your foundation when it comes to ESG. But if you don't have that and try to try to find individual KPIs, because you need to find some KPIs, then you miss the whole point. So I think that's really to start before anyone considering to implement it. There needs to be clear strategy for the overall firm, and a way to work with it and implement it going forward. Then I think it becomes quite, or relatively easy to implement it in a facility agreement. Even though, of course, the first time we had a lot of discussions back and forth but more on the technicalities to make the data useful.
I assume second time round it was an easier process.
Much easier.
Much.
Are there any sort of lessons that you learned during the process that you think it might be helpful for GPs or lenders to hear about? I mean, it sounds like you put a lot of thought into it in advance, and maybe that's the key lesson for them, is to front end it and make sure that what they're doing is consistent with their organization's goals generally with respect to ESG. But if there was anything else.
No, I think that is really the key, as I said, to make sure it's linked to the overall strategy when it comes to ESG. I need to find the right way to measure what you really want to measure, and be sure that you have a plan on what are you going to do with the data when it comes out. How are you going to use that to your advantage to improve the value creation that you have, or for any other purpose that will benefit your company. So I think that remains the number one important part of implementing the ESG here. That needs to be a firm-wide strategy. Need to be part of that.
It's probably also fair to say that if it's a large capital call facility, then providing lots of visibility through the process to your lenders is helpful. I think it's more straightforward when you have a bilateral or possibly two lenders to agree the mechanics relatively quickly. But one of the things EQT did very well through their process was to keep all of their lending syndicate involved in the thought process through the ESG KPIs by providing presentations to them, for example. And I think that helped the process significantly.
And in terms of, I mean, I guess that raises a point as to how it's managed going forward. Was there a separate role created? I mean, you do hear that some deals include an ESG compliance agent. I'm not sure if you had that there, but it does seem to be a new aspect to the financing that may actually bring about the need for some additional agency support, for particularly where you've got a big syndicate.
There's 2 points raised. One is, do you have a sustainability agent generally? And the other is, do you have a third party giving some oversight to the ESG KPI test themselves? On the sustainability agent, I think these facilities can have a separate role. It isn't that onerous a role. It's more of the collection of information and considering the margin adjustment and disseminating information, a bit like an agent, frankly. And so that you may see in some of the larger facilities. And then I think there is a role potentially for a third party auditor type person to be verifying information annually. Some of these facilities have it and some don't, I think.
Just to add there as well, I think that's going to be, I mean, now we're talking about the ESG in this particular instance with our KPIs. I think ESG as a whole is the requirement on reporting is going to increase. So I do believe in general you will see a need for other service providers to provide this reporting, the gathering of data and the analysis of that. So I think that on a wider scale that will become more standard, I think.
And I guess just before we sort of bring things to a conclusion, I guess we've been thinking a lot about implementing ESG for the financing for a new fund. Tom, I was wondering what your thoughts might be on how feasible it could be to sort of retrofit this into existing sublines for funds that maybe further into their life.
Yeah, it's a good question. I mean, after EQT did their 2 facilities, there was a lot of interest in the market on ESG margin adjustment capital call facilities. And there were a number of sponsors, I think, thinking about retrofitting ESG mechanics into existing capital call facilities. I'm not sure anyone ended up doing it, or at least last year ended up doing it, but it is possible. It's just a little bit more complex. It would only really work towards the start of the life of the fund. I think if you're close to the end of your investment period, what time do you have to improve ESG metrics in portfolio companies and make this worthwhile? And there's also a cost benefit analysis of reopening documents and negotiating something that will only have a utility for a shorter period than if you're starting at the life of the fund. So I think for those reasons, we've seen less progress in the idea of retrofitting ESG facilities, but those funds who were thinking about it will presumably be raising new funds relatively shortly, and so have the opportunity to do this day one.
Yeah. Well, I guess before we end, why don't we ask for some predictions? It is start of the year after all. How do you see ESG financings developing over the next 12 to 24 months? Is it going to be as big as the market seems to be suggesting? Maybe Adam, if you want to take that first.
Yeah, I think the simple answer from my side is yes. I do believe we're going to see more and more of that. I think if you look at the product as such, it has grown in numbers and size also over last year. So it's become a more mature market. I think it's ready for adding ESG to the facility agreements. So there's a high focus on them. There's I think the awareness of and the importance of ESG has dramatically increased, I think, especially during last year. So I think there is it's not a trend anymore. I think it's companies sees the benefit of really using ESG and implementing that into their business. So I clearly think that this is going to be implemented at the start of new facilities. I think going back to the previous question, I don't think it's maybe not worth looking back and see if we can implement it there, but to really have a very clear strategy, making sure that you also implement that in ESG in all parts of your business, and financing is definitely a part of that where we can make an impact. And then if you ask yourself that question again, if do you want to have sustainable financing or unsustainable financing, then the answer should be very, very simple. So I think it's a clear yes for me on that. I definitely think we're going to see more and more ESG linked credit facilities or in financing.
Tom?
Yeah, I agree. I mean, there's often new trends in the market, and last year the trends for fund financing, or the key trends, was ESG and NAV facilities for PE funds, and of the two, actually the one that generated by far the most interest from our sponsor clients was ESG, and I think the only constraints to not having done more ESG facilities last year, or possibly the two constraints, was the banks coming up to speed and people raising new funds. So assuming the funds market continues in its current strength, the fundraising market, I think there's going to be a fair number of ESG focused facilities coming down the line this year.
Great. Well, look, thank you both for your time. It's been amazing to have you both on to talk about this. I'm confident that there will be a lot of people watching this to hear what you have to say. So thank you from everyone.
The material and information contained in the podcast is for general informational purposes only. Any use of the audio within this podcast without the express consent of Cadwalader is prohibited. Quotes from this podcast may not be used without the express permission of the speaker.